Good morning. Good morning. I feel so at home. I look around and I see many friends. And when Ms. Ferran was giving her introduction, I wondered who she was talking about. But then I am first on the agenda for this morning, so I guess it must be me. I am very happy to be here with you this morning for this, the 23rd year of your continuing education seminar. And I'm thankful to Apotex and Cari-Med for extending this invitation to be here with you this morning. The title of my presentation is Customizing Creative Solutions to Mitigate Against Challenging Times. And I was very happy, Mr. Chairman, and I apologize, all protocols observed, to hear his opening comments where he spoke to looking for solutions. For far too long we speak about the problems, and it's very encouraging to see your theme this morning. As was said a little while ago, I am a Baptist deacon, so I have the tendency to speak for long periods. So I'll try to finish before 1 o'clock or thereabouts so that you can get the true Baptist experience this morning. I know many of you would have seen me trying to do Father Abraham. I'm happy that he didn't have many more sons because I think I had just gotten to the limit. But I'm very happy to be here. And for context, there is no magic pill. That's a pun at the Pharmacists. There's no magic pill for investing during challenging times. But you can put together some solutions that can work to your benefit. The Bible tells us that the wise man store up choice food and olive oil, but fools gulp theirs down. And you can find that in Proverbs chapter 20 and verse 21. In doing my research for this morning, I am reminded that this presentation is just intended to provide general information about investing, and past performance does not necessarily predict future performance. And before you go and invest, make sure that you speak to a qualified financial planner that can customize something for your solution. So that's my disclaimer. In 2014, Steve and Courtney decided to get serious about their savings, and that's Courtney, the female. They sat down and decided to take away 70% of their disposable income, and they downsized, and they said that they would put 70% of their income towards investments. In December 2016, 2 years later, Steve left his career in IT at the age of 35, and Courtney, who was 32, joined him in early retirement in April 2017, just this year. Just to be clear, saving money alone doesn't get you rich, nor does it evoke or enable early retirement. But investing was the magic sauce. Let the money work for you. Instead of keeping your money in a savings account in a bank, you let that money work for you. Indeed, they said that let the compound interest work for you, because that money has a possibility to gain interest upon the interest you would have accumulated. But let us talk about the challenging times that we are going through. And I think this is okay. And you can just pay attention to the slides as I go through. For context again, the the Jamaican economy is in a recovery mode. Following on the IMF deal that was signed in 2012, we have seen a period, an extended period of austerity, where development funds from the multilaterals have been incorporated into day-to-day experience. And you would have heard that I am currently serving as the head of the Public Investment Management Secretariat, which is the operational arm of the government's budget process. So before the projects go for consideration into the budget, I take a look at them to ensure that sound project management have been incorporated into them. So far, we have seen some early wins, so we do expect that we are on a growth trajectory. The access to development funds from the multilaterals have kind of directed us in how we should expend these resources. We have put into place certain traditional and sound project management practices to ensure that we get the true impact of the projects that we are putting into place. So for example, a road, a hospital, something that needs to be done, which is a public investment project, we have to balance which one is more important and which one we can stand to delay and so on. But also during this period, we have seen the devaluation of the dollar, down 13% between 2012 to December 2013. And then it took a more precipitous dive from November 2012 to June of 2017. During this period, we have seen periods of hyperinflation, and we have seen some sort of stability return. Just this last quarter, there was a minor contraction in the economy, but we do expect that we will see the true impact of our projects in short order. Over this period, you would have known that the dollar would have declined from $5 when I came back to Jamaica in 1989, and now it is now at 130. It is showing some level of stability there. And during that period also, we would have seen, as I said, periods of instability in the inflation rate. I want to take some time to look at this slide, which is showing you how the prices have moved. Now, this is coming from the US Department of Labor. But I want to show you the blue line where college and tuition costs have moved, which is usually how it happens in many economies. It runs at nearly 1.5 times the rate of inflation. And then we see where medical care has also increased as much as 300% since 1985. Gas is a volatile commodity, and you can see where that has moved, the light green, and the prices of shelter and the consumer price index has gone up by as much as 150%. Now, this is par for the course in several economies, but I want you to pay special attention to the costs for medical care and college and tuition costs, because children will always need to go to school, and we will always need to provide for that. Now, so the purpose of this conversation this morning is to speak about how to customize solutions to deal with these challenging times. So at the end of this presentation, Antonio will be publishing a series of questions for which you will be asked to answer true or false. So that's added encouragement for you to listen to the words I'm saying and not focus on the points. during periods of austerity and challenging times, people generally flock to what are called safe haven assets. Your gold, treasury bonds, some sorts of real estate, and defensive stocks, such as stocks in utilities and consumer goods, those that are not as volatile as other types of stocks. So one of the things that I would ask you is, what are you doing during these periods of difficulty? Warren Buffett, who is one of the richest men in the world, he looks at these periods as times when the best opportunities are available. I don't want to quote him, but number 45 in the US, he looks at these periods at times when he can get deep discounts on certain real estate options. So Warren Buffett offers the following advice, that you shouldn't save what is left after spending. You should spend what is left after you've put aside for saving. You should also remember that the chains of debt are light, very light, until they are too heavy to be broken. So you should look at also removing credit cards, reducing credit cards, and avoiding unnecessary loans during these periods, as they are dangerous and can quickly get you into trouble. So I want us to focus a little bit on some of the investment options that are available. As I said, there are some defensive instruments, your cash, such as the US dollar, the pound, the euro. For example, if you're going to be able to save, I would encourage you to save in a harder currency. For example, if you saved $10 million over time in Jamaican dollars, then that $10 million would not be as valuable as if you had converted that money to a stronger currency, and you would have seen it hold its value a little bit more. So a diverse portfolio can help protect your wealth from the vagaries of the market. There are 4 main types of investments, also called asset classes, each with their own benefits and risks. You can invest directly in these assets, or you may prefer a managed fund that offers a range of different investments and is looked on by a professional fund manager. I can't underscore that enough. Make sure that your fund manager is licensed with the Financial Services Commission and they're qualified to give you the advice that they're espousing. Learn more about the different ways to invest. So we have some growth instruments in equities. People buy art and put it away safely. And as I said earlier, there are some real estate and property investments, and I'll go into that a little later. Defensive instruments generate regular income and are usually aligned to the stage of your life. So a younger person may seek to do something in terms of a defensive instrument that has a longer maturity date and is also has a higher yield. Whereas someone who is just getting close to retirement is going to want something that is a little bit more easier liquidated. Some of the common types of defensive instruments are cash, fixed interest instruments, and the stock market. You shouldn't be too risky. Don't put all of your eggs in the same basket. And the conventional wisdom is that you should buy early and forget about it. Warren Buffett says, set it and forget it. Common types include cash, fixed interest, and stock market. You should focus on getting a regular income as opposed to growing in value over time. Take the approach that is aligned to your stage in your life, and you should try your best to forget about these investments until it is that you're really going to need it. Cash investments. Some of the pros and cons of cash investments are that the pro is that it's a high interest saving account where you can get a stable regular income through interest payments. It's one of the lower forms of investment in terms of risk. The value or purchasing power of cash, however, could decrease over time unless you do what I had recommended a little earlier, which is to save in a foreign exchange currency as being recommended. The cost of goods and inflation, the cost of goods and services rises quickly, and it means that your money has less meaning than it used to. That's a declining purchasing power. Fixed instruments such as term deposits, government bonds, and corporate bonds are relatively safe investments and stable investments. A term deposit is the type of fixed investment in which your funds are locked away for an agreed period of time at a fixed interest rate. Earnings at a similar or slightly higher rate than a cash account, and it's depending on the amount and terms that you invest in for the duration of the term, so you can't be tempted to spend it. And usually these instruments have some sort of a penalty for breaking them, so you should be very careful before you encash these types of investments. The advantages of term investments are many. As I said, there's a guaranteed interest rate for the agreed period. If the market crashes, your funds are relatively safe, unlike the stock market, which fluctuates depending on the day. Often, higher rates of interest accrue in term deposits than other savings accounts and competitive yields. The disadvantages are that you can't readily access your money unless you're prepared to pay penalty fees. If interest rates increase, you will not benefit from a rate as your rate is fixed. So if the austere measures or the austere period passes and rates start to improve, you would have still been locked in. So it's a catch-22. You would benefit if the rates go down, but you'll be a little disadvantaged when the price goes up. It's also important to remember that this is not a liquid asset, so it is not something that is readily encashed, and it's less flexible than some other investment options. So if you need to have an income or an urgent need for resources to deal with an urgent matter such as medical care or college tuition for your children, this is not necessarily the best option for you. But in terms of preserving the value of your investments during difficult periods, it is one of the more sought on forms of investment. I want to move now to government bonds. Government bond is an instrument which is issued by a national government, generally with a promise to pay you periodic interest payments. Now, you would have on any given day heard of various offerings by the Bank of Jamaica, and they are inviting you to invest in government bonds. They're relatively safe. Again, they repay on the face value at the maturity date. So unless you're ready to wait until the maturity date, this is not the form of investment for you. advantages of investments in government bonds is that they have relatively low volatility. They are relatively high in their liquidity, and they're protected by law and a variety of term structures. The disadvantages, though, are that they are subject to risks such as interest rate fluctuations, the stability of the government in question is also something to look at. And Jamaica has a relatively stable government. We are one of the democracies the world over that is governed by the ballot and not the bullet. There is some level of stability in Jamaican bonds, and so that is something that you should look into. There is a prepayment risk if you decide to encash early, credit risks and risks in reinvestment and liquidity. Treasury bonds, there is a medium to long-term debt security, and it carries an annual rate of interest which is fixed over the life of the security. Treasury index bonds are medium to long-term bonds. The capital value of the bonds is adjusted for movements in the consumer price index, which is the tool to measure inflation. With Treasury index bonds, interest is paid quarterly at a fixed rate on the adjusted face value of the bond. At maturity, investors receive the capital value of the bond, which is the value adjusted for movement in the consumer price index over the life of the bond. Now, in terms of safety, because we're talking about challenging times, some people would want to put their investments in safer, more stable instruments, and those tend to be found in the government bonds or quasi-government bonds. As you move down the table, though, banks and company bonds tend to be more volatile and more risky forms of investment. So if I were to recommend an investment in bonds for the older persons, I'd be looking at more safe bonds, investments in bonds, and the younger ones should have a more risk-averse nature or risk-conservative nature, so they would be more interested in taking a higher level of risk. So we talk about growth investments, those types of investments that you'd want to make over time, especially during challenging periods. Growth investments increase in value over time, and they have the potential to pay out income occasionally, depending on the type of instrument. Prices can, however, rise and fall significantly. Growth investments may deliver higher returns than defensive instruments. However, you also have a stronger, more realistic chance of losing your money. Growth investments can be found in shares, real estate, art, what they call penny stocks, which are those stocks that you might buy 100,000 of them. Say a cable and wireless is very low in its value, but if it moves up by 10%, then that is significant. And $1 to $1.10 is not unheard of in our market. There are futures and options contracts. Of course, foreign currency is a viable growth investment, and speculative real estate such as undeveloped land. That piece of land in front of my church And for those of you who don't know my church is the church without walls in front of Barbican. Our wall was the first one that came down in the rains. I tease the children that they were marching around the walls of Jericho for too long. So that piece of land in front of our church is going to be worth a lot of money very soon. And so the individuals who would have purchased that and just speculated on it stand to gain significantly. At one stage they wanted to make a go-kart rink out of it, and we didn't really appreciate that. A share in a company is a single unit of ownership of that company. Shares are generally bought and sold through the stock exchange. The value can rise, but of course it can also fall. And we have seen a higher level of interest in our stock market recently. Bloomberg ranked it in 2015 the best performing stock market in the world. And we have seen this year alone several IPOs, initial public offerings of companies such as Main Events, I don't remember the full name, and also the tea companies on their Jamaica teas. And you can make some very good money on the stock market. Warren Buffett, again, believes that you should always play the long game. If you aren't ready to hold a share or a stock in a company for 10 minutes, for 10 years, you shouldn't think about holding it for 10 minutes. Don't get caught up in the daily market valuations, because you can create a lot of anxiety, and you'll need to see a pharmacist to prescribe something for you. You should start early and build your portfolio and set targets and reevaluate those targets regularly. So if you bought a share in a company and you say you're going to save it, you're going to try and get 25% on rate of return on that investment. When you have accomplished that task, of course you have done your homework, you have done your due diligence, you have spoken to qualified financial advisors. Once you have reached that target, step back. Step back, reevaluate where you are, and if it is that you need to reinvest or make another form of investment, then do that. Normally what I do is, once I have reached the target, then I retreat and put that gain into another stable investment. The cons of investment in shares is that sometimes when you receive your income from dividends, you may have a company that does not declare dividends. Now you have some shares such as Carreras that you can always depend on to get a good dividend check from. And then you have some others that they're risky and you will not get back that investment or a dividend. A dividend is a portion of the company's profit which is paid out to its shareholders. And as I said, the value of shares may also fall. Now, once you start investing in the stock market, you suddenly start to become very investment savvy, and you're listening to all the company news. So you would be listening to the news and you hear that Grace Kennedy is going to be opening up a new distribution center, or they're going to start looking into Africa, markets in Africa. They're going to start producing for export elsewhere. These are signals that you pick up on, and you can find out whether or not this is a good equity to purchase. On the flip side, you might hear that maybe the market for some products are not doing as well as you would have thought, and then you would need to reevaluate your investment. But as I said, play the long game, look at holding this equity for some time so you can really reap the true value. I like to call it unlocking the value of these shares. Some of the concerns about shares is that they can be volatile from day to day. They are best suited for long-term investors who are comfortable with withstanding these ups and downs. And it is considered as one of the more risky types of investment. Property investments. Many of you own land in various parts of the country. Property investments include investments in houses and units, commercial property for individual offices or office blocks, retail premises such as shops, hotel rooms, inns or hotels, and industrial property such as warehouses. The pros and cons of property investments is that the value of the property may rise, and again, it may fall. The prices are not guaranteed. You may have, my mom used to tell me that Torrington Bridge area was first class area back in the day. Now, not so much. It can be more difficult than other investments to sell quickly. Of course, you have to remember that you're going to need to pay property tax, and especially for those parcels of land that are in precariously placed, for want of a better way of saying it. You may want to look at the cost to ensure that it's properly secured, that you trim it now and then. So that may become costly. It may not be suitable for you if you need to access your money, the liquidity of these types of investment. In summary, we encourage you to do your homework. Speak to a qualified financial planner. Start early, save often, and stay invested. It's not enough to invest. You have to stay the course. Sometimes during periods such as the ones we're in now, you're tempted to go into some of these investments. But if you can avoid it, try to do so, because you would not be extracting the true value of your investments. Use an investment strategy that is representational of the stage in your life. I said earlier that young people have the ability to be a little bit more risky in their investments, and an older person would want to tailor something that is a little bit less risky and maybe less long-term, so that they can have their access to the money to carry out some of their very, very important activities. You should maximize your strengths, minimize your weaknesses, and use your assets. If you're going to invest in something, try and invest in something that you truly believe in, because if you don't, you're going to have some challenges in the long run. You have to believe in what you're investing in. There's a saying that the grass is green on the other side of the fence, but the water bill is higher. Greater risks mean greater rewards. I always remind persons who I'm speaking to about this, that the higher the potential reward, the greater the risk. Many of us would have been burned through some of the Ponzi schemes that were a feature in Jamaica a few years ago. But several individuals went to those types of investments knowing that it was high risk. Saving for education for your children should be projected at 1.5 times the standard inflation rate. And I would encourage you to save in an overseas facility that would allow you to really hold the value of your investments. Education savings should be placed in conservative, less risky instruments that are easily liquidated. And we know that an investment in education will always pay dividends. And if you think education savings is expensive, try ignorance. I want to leave you with a few points, and these I would encourage you to write down so that when you have the quiz, you may be able to answer them. I would encourage you to pay down your loan balances. This is one of the customized solutions. It's not rocket science, but credit card debt in particular, those debts that can be 30, sometimes even 40%. You find yourself that if you take credit card debt to pay for some everyday expenses, you find yourself paying for them 2-3 times over the course of the time that you hold that debt. You should pay down unnecessary loans, stay clear of credit card debt, evaluate and discern the debt, and try and figure out the difference between your needs and your wants. Look beyond tomorrow's headlines. Play the long game always. You should stay the course. Even though the investment is volatile and you see it going down, over time, if you truly believe that you have made the right decision and you've done the market research, that might just be a periodic blip. And I would encourage you to speak to your financial planner when you see your investments going south, so you can see what the long-term projections for those investments are. Look for the value in your investments. Truly search them out. Keep money in the stock market and don't be overreactive to the momentary fluctuations in the index. The index has appreciated several 100% over the last 20 years. And if you follow the examples and the advice of the people who are truly making money, they are the ones that are holding these investments for the long term. You should remember always that a penny saved is a penny earned. And when we go back to what I had said earlier about the credit card, don't buy what you can't afford. If you can't afford to pay cash for it, you can't afford it. And always remember that behind every dark cloud, there is a silver lining. Better must come. The key is not to panic and to recognize that this is a cyclical dilemma, and it will pass. Some investors thrive during periods such as the ones we are in because they know that this is the best time to get the best deals. There is a saying that the Chinese word for crisis is also a combination of the words for opportunity. I don't know how true that is, but it is usually during periods like this then that people who are wealthy make the most gains. The indicators are mixed now. So prudential investments must be done for the short term. As I said, there has been a minor contraction, but the long view is still positive in Jamaica, as indicated by our stock market. So I would encourage you this morning to customize your solutions to deal with these financial times, knowing that it can and will get better. Thank you very much for your time, and I'll now invite any questions if you have them. No questions? I was clear as mud. Thank you very much. Yes. Preference shares are good instruments. They are less risky than common shares because you stand to gain greater when the dividends are paid out, and they are normally paid out a regular basis more than common shares. Yes, ma'am. Morning. Thank you.
That's what I should invest in. But you did mention in government bonds where a con was a reinvestment risk. Could you kindly elaborate on that?
Okay. There is always a risk that when you withdraw or you terminate those instruments and you reinvest them, they'll be at a lower yield over time.
Thank you, Deacon. Thank you for this talk. We know that investment is a hard ball, and it's not really for the faint at heart. A couple of years ago, I was invited along with some others to a private seminar by overseas investors to invest in gold, silver, and tin. We know that this is the futuristic for the future.
To invest in?
Gold, silver, and tin.
Yes.
And this is the futuristic investment for the future. Is there a future for this type of investment in Jamaica?
There's always an investment opportunity in those, and as I said, those are defensive investments. They tend to hold their value more. I mean, from we used to barter, our ancestors, they used those precious metals, and they tend to hold their value over time. The challenge with those types of investments is that it's not easily turned into cash because the price at which they're worth is dependent on the price someone is willing to pay for it and not the value that you ascribe to it. I would not see us going back to trading precious metals. I think they're going more into Bitcoin now, but I'm not going to speak about Bitcoin today. I don't have enough information, and the track record has not been good just yet. If you invite me next year, I'll tell you about Bitcoin.
Hi, good morning. Just want to ask a question. What's your take on IPOs, and what's your take on it, and if it's a best investment option to undergo?
Initial public offerings they have to be evaluated on a case-by-case basis. You have some IPOs that the die is cast even before the offering is made. When you go to purchase, for example, 100,000 main event shares, they give you 1,000 because it has been oversubscribed. I think main event sold out in something like 17 minutes, the shares that were on offer. So you have to evaluate each offering. But I do see a heightened level of interest and activity, particularly on our junior stock market. And so I would encourage everyone here, at least on the case-by-case basis, to do their research about those companies. Again, invest in companies that you believe in and you believe in the business model. Get the prospectus. The prospecti appear to be written more for the common understanding now. So I would encourage you to read the prospectus of these companies, see what the long-term vision is for that company. For example, Main Event wanted to go into other areas, go into other jurisdictions to do some of the same. So you have to look at what the company plans to do, but that's a very difficult question to answer generally. It has to be evaluated on a case-by-case basis. But an IPO is always an attractive investment because you get it at the par value, the value on offer, and then you usually see within the first 30 to 60 days what that company is really going to do in the long term.
Okay, we have one final question, just to...
This gentleman has had his hand up for some time.
And you want to answer his question?
Well, no, I want to answer
what about this
the
lady?
lady first.
I was wondering.
No problem.
Okay.
Thank you very much for an interesting presentation. But could you elaborate a little more on the pros and cons of investing in art, as you have it as a growth investment?
Thank you very much for that question. Now, Jamaica has some of the finest artists, whether it is painters or sculptors in the world. And I'm not talking about the Marcus Garvey statue now. And so these items tend to appreciate over time, especially those hungry artists that will meet their demise, untimely though it may be. And so these items tend to increase in value over time. The disadvantages of art, however, include having a place to store it and store it safely. Fire, flood. It is also subject to the price that someone else wants to place on it. So it is a defensive instrument, but one that is risky. Sir?
Just a note, this is the final question for this section. All right, thank you.
Okay, thank you for such an informative presentation. Now, the title says mitigating against challenging times. I remember in recent times the government was proposed by the IMF to give them a lower interest rate over a longer payment term. I'm not sure if the government had signed on to that, but what is your take on consolidating funds and paying over a longer term with a lower interest rate just to mitigate for those challenging times? What is the implication for that?
Well, the most direct, thank you for your question. The most direct implication, of course, is that you would be saddled with that debt for a longer period of time. But certainly, if you can look into debt consolidation, bring all of your costly loans, maybe you have something from courts, maybe your car, you can bring it all under a single payment, then you'll be able to better deal with the volatility in the market and be able to manage your loan balances over that period of time. But of course, the more direct result of that is that you will have that debt for a longer period of time. I do encourage debt consolidation, especially for those credit cards and other high interest facilities that have the potential to saddle you with debt and to make things much worse for you during the periods of austerity. Thank you, ladies and gentlemen, for your time this morning. I hope I wasn't too boring, and I look forward to a wonderful rest of the day.